In March 2026, Porsche reported 3.9 billion euros in extraordinary charges. Automotive profit collapsed 98% in a single fiscal year. 2 months later, Porsche shut down 3 subsidiaries tied to its electric strategy and folded its digital technology division into research and development. The unit that was supposed to build the electric future those billions had paid for was gone. All of it was the wreckage of one bet, a bet to turn the most profitable car brand in history into an electric car company. They built the factory, signed the battery contracts, and scheduled the death of their most iconic engine. Then the battery partner went bankrupt, the factory ran at half capacity, and the only car customers actually wanted was the one Porsche had been planning to kill. They bet against their own identity. The identity won. How does the most profitable car brand in history bet against the one thing that made people fall in love with it? A Porsche driver in 2022 would never have described what they loved about the car in terms of horsepower or lap times. They would have talked about the flat 6 engine note, the way the rear engine transferred weight through a corner, and the mechanical connection between steering wheel and asphalt that no electric motor has ever replicated. Those things were what made a Porsche feel like a Porsche. And in 2022, Porsche was not just a car company, it was the closest thing the automotive industry had to a luxury house. 18% operating margins on 6.8 billion euros in profit. Ferrari was the only brand on earth that came close. The Porsche 911 had been in continuous production since 1963, selling better than ever, precisely because Porsche had refused to reinvent it. Customers paid happily. A fully loaded 911 Turbo S could cross 250,000 euros before the buyer had even picked stitching colors. Then came the initial public offering. September 2022, Frankfurt Stock Exchange, a 75 billion euro valuation and 9.4 billion euros raised, the largest European initial public offering on record by market capitalization. Analysts used words like generational. The financial press called the business bulletproof. Then, on the back of that confidence, Porsche made the decision that would cost them everything they had just celebrated. Oliver Blume announced that 80% of the lineup would go electric by 2030. The Macan, their best-selling car, would go fully electric. The 718 Boxster and Cayman, the entry-level sports cars that had introduced a generation of drivers to the brand, would be killed and replaced with battery-powered versions. The combustion engine, the thing that had built Porsche's identity across a century of motorsport, was being sent toward early retirement. This decision seemed small at the time. It was not. Because it was never really about the cars. It was about identity. Porsche was choosing to become a different company. The flat 6 sound, the steering feel, the raw mechanical honesty of a rear-mounted engine, all of it was being scheduled for replacement by silence. And the assumption underneath the entire strategy was the one nobody stress-tested. Porsche believed its name alone would be enough to make buyers choose a silent, expensive electric car over a faster, cheaper, and more technically advanced alternative. They never seriously considered that such an alternative might already exist. The Taycan was the first place the bet made contact with reality. Porsche had expanded production capacity to roughly 40,000 units per year for that single model, building a dedicated facility in Zuffenhausen specifically for the car. In 2021, they delivered over 41,000 Taycans globally. The factory hummed. By 2025, that number had fallen to 16,339, a 60% decline in 4 years, a factory running at barely 40% of what it was built to handle. Consumer Reports named the Taycan one of the least reliable vehicles on the market. Porsche attempted a mid-cycle refresh in 2025, improving range and charging speeds. Depreciation made the damage worse. 3-year-old Taycans were selling for roughly half their original purchase price on the used market. A buyer could spend over 150,000 euros on a Taycan Turbo S and watch it lose more value in 3 years than most cars cost new. A baseline Tesla Model 3, priced at roughly a third of the Taycan, offered comparable range and a faster-growing charging network. The product that was supposed to prove the strategy could work had instead become the evidence that it could not. If that were the only problem, Porsche might have absorbed the hit. But China was about to make everything look worse. At its peak, China accounted for roughly 31% of all Porsche deliveries worldwide. That is not a market. That is a dependency. Dependencies break fast when the market changes direction. For most of the previous decade, young, wealthy Chinese professionals treated a Porsche the way a previous generation treated a Swiss watch. The Cayenne and Macan drove that demand. The Taycan was supposed to add a new chapter, telling the market that Porsche was both prestigious and modern. Instead, the chapter was written by someone else entirely. In March 2024, Xiaomi, a phone company, launched an electric sedan called the SU7. It received 50,000 firm orders in 27 minutes. More demand in half an hour than Porsche's flagship electric vehicle generated in an entire quarter in China. The SU7 was faster to update, more digitally integrated, and priced well below a Taycan. That single product launch told the entire Chinese luxury market something Porsche was not ready to hear. For younger Chinese buyers, the psychology shifted overnight. Owning a technologically superior domestic brand was no longer a compromise, it was a preference. Porsche deliveries in China dropped 26% in 2025 alone, the fourth consecutive year of decline. Dealers began slashing prices by approximately 30% just to move inventory that was sitting on lots. One franchise operator in Shenzhen, who had invested over $2 million in a Porsche-branded showroom, described watching Taycans sit on the lot for months while every Porsche with a combustion engine sold within weeks. Nobody in Stuttgart seemed to notice the pattern. A Porsche dealership cutting $40,000 off the sticker is not a promotion. It is an admission that the waiting list, the premium, the entire economic logic of the brand has collapsed in that market. That is what a luxury brand sounds like when it stops believing in its own price. Every discounted sale in Shenzhen or Shanghai eroded the global brand equation. Meanwhile, Porsche's electric lineup was collapsing across China, but one model line back in Stuttgart was quietly posting numbers nobody in the boardroom expected. Porsche responded to the China crisis by announcing it would halve its dealer network from 150 locations to 80 by the end of 2026. In luxury automotive, shrinking your retail footprint is the equivalent of a white flag. Then the supply chain behind the entire bet collapsed in Sweden. Northvolt, the battery manufacturer that Porsche had contracted as the sole source of cells for the electric 718, filed for Chapter 11 bankruptcy in the United States in November 2024, debts of $5.8 billion. The practical consequences for Porsche were immediate. The electric 718 was pushed from 2025 to 2027 at the earliest, with the incoming CEO openly evaluating whether to cancel the program entirely. But Porsche had already stopped accepting orders for the gasoline 718 in September 2025, clearing the production line for an electric replacement that no longer had a battery supplier. That decision left the company with no entry-level sports car at all, a product gap with no confirmed replacement. The bet had taken the 718 off the road and left nothing in its place. Porsche booked 700 million euros in battery-related write-downs tied directly to the collapse of its cell supply strategy. If stories like this one are useful to you, subscribe. Every video goes deeper than the headlines. When Porsche finally published the full damage report, the numbers were worse than the headline suggested. 2.4 billion euros went to strategic realignment costs, 700 million to battery-related write-downs, and another 700 million was absorbed from United States tariffs on European-built vehicles. Not every euro traced to the electric vehicle bet directly, but nearly all of it pointed back to the same decision. Operating profit in the automotive division fell from 5.3 billion euros to 90 million. The operating margin went from over 14% to 0.3%. For context, the IPO prospectus had shown investors a business generating 18% margins. That number had become 0.3% in 3 years. Porsche was removed from Germany's blue-chip DAX 40 index in September 2025, less than 3 years after joining. Shares sat approximately 50% below their IPO price. Every investor who bought at the listing had watched their position get cut in half. Blum was replaced as Porsche Chief Executive Officer by Michael Leiters, who started on January 1, 2026. His previous roles tell you everything about what the board now believes went wrong. Leiters spent 8 years as Chief Technology Officer at Ferrari, then served as Chief Executive Officer of McLaren. Neither company ever chased volume, abandoned combustion identity, or tried to become something it was not. Ferrari builds fewer than 15,000 cars a year and guards its engine sound the way Porsche once did. McLaren has never produced an electric vehicle. The board looked at the wreckage of the electric vehicle bet and hired someone whose entire career said the bet should never have been made. That hiring decision is a confession disguised as a press release. And in his first earnings presentation, Leiters chose 3 words for the company direction: leaner, faster, desirable. That last word is the one that mattered. Desirable is what you say when you know the product stopped being wanted. Meanwhile, the 80% electric vehicle target was officially dead. Combustion and hybrid options were being added back into models that had been announced as pure electric. The company that had declared the retirement of its engine was now betting its recovery on the exact engine it had been trying to retire. And this is the part none of the other coverage told you. The electric Macan sold over 45,000 units in 2025. By volume, that looked like a success. But volume without margins is just activity, and the $3.9 billion in write-downs proved that Porsche was spending more to sell electric cars than it was making from them. While the electric strategy burned cash, one car was setting records. The 911. Deliveries hit 51,583 in 2025, an all-time high. In the first quarter of 2026, 911 sales in the United States surged 83% year-over-year. An old, analog, petrol-burning car that vibrates through the steering wheel and makes the sound that a car of the future is supposed to stop making. The rear-mounted flat six does not hum. It does not whir, it howls. And every driver who has ever sat behind that engine knows the difference between a Porsche and everything else on the road within the first 3 seconds. That sound, that feel, that mechanical honesty is what the electric vehicle strategy was designed to replace. The one model explicitly protected from electrification was the only model still growing. And the 718, the car Porsche had discontinued to make room for its electric replacement, had its sales climb 15% the year before they pulled the plug. Customers were panic buying the combustion version because they could see what was coming. Porsche responded by killing it anyway. The car they bet on delivered 16,000 units. The car they refused to change delivered 51,000. The car they killed was selling better than ever the day they ended it. One question remained, and the answer was not one Porsche had prepared to give. The parent company that was supposed to backstop all of this was also on fire. Volkswagen Group, which controls Porsche through majority ownership, reported a 44% drop in net profit for 2025. Operating margins across the entire group fell to roughly 2.8%, the lowest since the Dieselgate scandal in 2016. 50,000 job cuts were announced across Volkswagen's German operations by 2030. The IPO in 2022 was supposed to give Porsche independence from Volkswagen's problems. Instead, it created a second set of masters, public shareholders demanding quarterly returns while keeping Volkswagen's control intact. Porsche cannot get emergency capital from Volkswagen because Volkswagen needs emergency capital itself. Volkswagen cannot stabilize because its most valuable subsidiary is dragging the numbers down. Neither company can rescue the other. Both are hoping the other will stabilize first. That is not a strategy. That is a standoff between two companies standing in the same burning building, each waiting for the other to call the fire department. Porsche built the most profitable car brand in history by refusing to be everything to everyone. It sold fewer than 310,000 cars a year and generated numbers that mass-market brands needed 10 times the volume to match. The clarity of that identity was the product. Then in 2022, at the exact moment the company felt most invincible, Porsche made a single bet to become something it was not and spent 3.9 billion euros discovering that the only thing customers wanted was the thing it had been trying to replace. The Flat 6 is still running, the bet is not. If you want to see how a similar story played out at a company that also let one decision destroy a $20 billion comeback, that video is on screen now.